Welcome back to the channel. A lot to unpack, a lot to talk about this week. Donald Trump's Liberation Day was on April 2nd. A lot of havoc, a lot of market uncertainty. And the question is why is Donald Trump doing this? Is there a reason that Donald Trump is creating this uncertainty in the markets? And what is that uncertainty going to do for the United States? And what could it mean for Canadians, especially as we look at interest rates in the near-term future here in Canada? So this week I want to share our thoughts and opinions on the most recent tariff conversation, what it could mean for Canadians, so stay tuned. Once again, thanks for stopping by. If you have not subscribed to the channel, we invite you to do so. Hit that notification bell so you can stay up to date with everything that's happening in the mortgage and real estate marketplace, especially when it comes to tariffs, this conversation. More importantly, we are heading into a new Bank of Canada rate announcement coming up in April. And with the most recent data coming out, what could all this mean for the Bank of Canada's next move? So first, let's start off by talking about the events that transpired earlier this week. On April 2nd, we heard from Donald Trump about the tariffs, this reciprocal tariffs that we've been highly talking about. We've been really having this conversation about what's to come. And a lot of the markets, a lot of individuals, a lot of Canadians were looking at this date for certainty or some more clarity, but we didn't end up getting that on April 2nd. Actually, what we got was more confusion. We basically saw a market, including the stock market, take a massive tumble, huge correction, basically a correction that we haven't seen since 2020. And ultimately, this is creating a lot of pandemonium. So now that we're talking about the market, this channel is not really geared to the stock market, but I think there's a good conversation to be had here. Actually, one that talks a little bit about some of the theories that are floating around right now. One that we wanted to talk about a few months ago, but really weren't certain if this was an actual valid theory. But now, as we continue to see this uncertainty, which we'll talk about in just a moment, it's starting to come to mind that this could be the reason why Donald Trump is creating all this uncertainty. So what we see right now is a stock market that's definitely corrected significantly since November. Basically, a lot of losses being showcased right now in the stock market, depending on where you are. But ultimately, this is maybe all planned by design. If we recall, Donald Trump really wanted to push the U.S. Federal Reserve, Jerome Powell, the head chair, to cut interest rates in the U.S. And Jerome Powell did not respond well. He's not going to cut interest rates just because the President of the United States says you need to cut interest rates. They are two independent bodies. Remember, we talk about monetary policy, right? The central bank, for example, the Bank of Canada, Governor Tiff Macklem, what they can do with interest rates. And then there's the fiscal policies, what the administration can do, the rules and the actual laws that they can pass. So we have these two different competing elements. Now, ultimately, Donald Trump wanted the U.S. Fed to cut interest rates, to which they said no. Now, ultimately, Donald Trump might be saying, well, we're going to get what we want one way or another. So by creating this uncertainty in the market, you're going to have investors, a lot of people in the stock market, basically fearful. When you have a lot of fear, people leave the market, they sell off. That's what we're seeing happening right now. A lot of fear, a lot of fundamentals for these companies may have not changed, but the fear itself has created a lot of movement, a lot of outflow of capital. That capital generally can go into multiple different other asset classes, but generally what we see is either cash or bonds or treasuries. And what's happening right now is a lot of these investors are leaving the market, maybe going into a cash position, or they're going into what's called treasuries, bonds. And if you go into a thing like a 10-year treasury, which is super important when we think about government, the US is looking at, right, and even here in Canada, the 5-year bond. Well, if you look at what's happening, a lot of investors might be fleeing to a 10-year US treasury, right? Now that's going to bring down the yields. That's obviously going to bring down the prices of those, which will in turn bring down mortgages in the US. I mean, if you take a second and think about that, if the investors leave the market where they're getting higher returns, what we call a flight to safety, bonds are generally safe, right? Government's going to pay back their debt. They're going to pay back their debt holders. Who's funding them? They're going to pay it all back. Generally a safe instrument. And, the 10-year seems to be the mark. Now, obviously, there's a lot more to this than meets the eye. It would take a lot more of a timing to have this conversation. But in a simple way, that's what's happening. So if we have that happening right now, well, what's the benefit? Why would this be beneficial to the administration? Well, if we think about it, there's a couple things. One is that the US has $1 trillion of debt outstanding. And basically just at the current moment to pay the interest on that $9 trillion, it is that actually outpaces what they spend in military and defense. So they're spending more on paying the interest on that 9 trillion than they are paying for military and defense. So if they can reduce the interest rate on that 9 trillion, renew it, like many Canadians who are renewing their mortgages into a cheaper interest rate, restructuring, consolidating into a cheaper payment, well, it makes things more manageable for the government to run that deficit or to pay, interest on that money. So there's the rationale behind what is sort of happening right now. So maybe you're aware of this theory, maybe you've heard of it, maybe you haven't, but ultimately this is the conversation right now. In addition to that, remember, we have to understand Donald Trump wanted lower interest rates. He wants to pay off the deficit. He wants to remove income tax. He wants to build manufacturing. I mean, you look at the tariffs, that they don't make any logical sense. I mean, how do they come up with these numbers? It's basically a calculation that many economists can't even figure out, how they just came up with half. And, this is literally a complete, as some people would say, a fugazi. But here's the thing, it creates uncertainty. And we talked about Donald Trump, the art of the deal, start from a point of, really high, unlikely outcomes and make your way down. And we're sort of getting this further uncertainty in a nutshell when when the media outlets interview, the Secretary of State, the Secretary of Treasury, Lutnick and Bassett, and basically ask them, hey, what's going on here? Is this negotiable, this 10% baseline tariff across all these other countries, of which, Canada and Mexico were not included because we already have our own tariffs and part of CUSMA and part of the USMC agreement. I mean, ultimately, a lot of things there, but, ultimately, are we going to see, further tariffs on other countries? Are these negotiable if China or Vietnam or one of these countries wants to come back? And one person saying, well, no, this is it, it's done. And then Donald Trump on Air Force One is like, well, no, if they come together with a good deal, we'll negotiate. And ultimately, when you have uncertainty, you have no direct course of action. Generally when we know that these things are happening, I mean, look, the markets get leaked information. And nothing was leaked about these reciprocal tariffs being half, because I personally think they didn't even have a plan until probably a couple hours before, when they created this arts and craft board that they came out with and showcased and started talking to. I mean, it just completely out to lunch. I really hope I'm right here, but I don't think Donald Trump's really going to go through with these tariffs on April 9th. I really think it's just basically a ploy to get more of these countries to open up, to reduce those tariffs. Doug Ford had come out not too long ago in Ontario saying, hey, we'll go dollar for dollar, or, a tariff for tariff. So we'll go to zero if you go to zero. Maybe that's what he's looking for. He wants to bring American manufactured, American product into other parts of the world where previously maybe they weren't there, especially the automotive. I think he's really behind the automotive part of it. So ultimately, anyway, with all that being said, it's super important to understand that I think there's a method behind the madness. Now, what does all this mean for Canadians, right? What does it mean for mortgages? Well, uncertainty, like we talked about with the Bank of Canada, especially heading into April 16th, the next Bank of Canada meeting, well, we're definitely going to expect to see a Bank of Canada cut at a bare minimum, at least 0.25%, maybe a little bit more. We did see unemployment tick up to 6.7, 33,000 jobs being lost. And we've talked about this on the channel before. There was a little bit of a stalemate on those numbers. Now we're seeing those numbers spike up, right? We're definitely seeing the impacts of the potential fear and uncertainty around these tariffs. You have major automotive manufacturers like Stellantis taking some time off, maybe, seeing if that's going to be something that's continuing on. We're definitely going to have a lot of manufacturing slowdowns, a lot of people, waiting to see exactly what happens. So that's creating a lot of uncertainty for the Bank of Canada. Remember, the Bank of Canada is going to shoot now, ask questions later. By that, what I mean, we talked about in a previous episode, is if we get into that recessionary fears here in Canada, they're going to have no choice but to reduce that interest rate, bring it down. But if we see inflation continue to rise, if these products continue to create undue pressure in the economy, especially with inflation, well, the Bank of Canada is going to have to address that issue down the road, which means, we may see interest rates spike up in the next little while. So this is creating a lot of conversation around variable rate mortgages. Should Canadians be taking that product on? And ultimately, I want to have a conversation about that in the weeks to come. But as we look at the variable rate mortgages, we think about the Bank of Canada, there's going to be some more cuts. We definitely see what's happening right now with US Treasuries. A lot of people buying, a lot of the US investors buying up those Treasuries, bringing down the prices. That's in turn driving down bond prices here in Canada. Remember that connection. The bond prices here in Canada determine where fixed rate mortgages are headed. And if we continue to see that stability, we continue to see that actually fall off and those actual bond yields continue to drop, well, then we definitely could see the banks, most of the major banks start to drop their interest rates, and that they're doing. We're starting to get wind that a lot of these mortgages in the next little while, we're going to see interest rates potentially on the fixed side and the variable side come down. Once again, that we'll have a conversation about. We'll be talking a little bit more fixed and variable when we do our next mortgage rate update. So make sure you're subscribed to the channel if you want to stay up to date with what's happening with interest rates. But right now, let me know your thoughts. Do you think Donald Trump is intentionally trying to crash the market in order to make things cheaper so that they can refinance that? You think that's a good theory, or you think that that holds no water? Let me know in the comment section below. But until next week, thanks again for stopping by.